What if I told you that the money in your pocket, the savings in your bank, and even the pension you've worked for your entire life could be at risk? Not because of a scam, but of new UK laws. From hidden taxes to digital money that tracks every purchase, the rules are changing fast, and they could quietly strip away your financial freedom. In this video, I'll reveal the 10 laws that could cost you everything, and number 10 might just leave you speechless. Stay tuned, because you need to know this before it's too late. Number 1. The Digital Pound, CBDC, Central Bank Digital Currency. The UK is moving closer to introducing a digital pound, also known as a central bank digital currency, CBDC. At first, it sounds like a modern upgrade, money stored safely in your digital wallet instead of a bank card. But here's the catch. This isn't like Bitcoin or other cryptocurrencies that operate independently. A CBDC would be fully controlled by the Bank of England and linked directly to government policies. That means every pound you spend could potentially be tracked, traced, and even restricted depending on new regulations. Imagine a world where using cash at your local shop becomes impossible, and every purchase you make leaves a permanent digital footprint. Supporters argue the digital pound could make transactions faster, reduce fraud, and give the economy a boost. But critics warn it could be the start of a cashless society where people lose financial privacy. With cash, you have anonymity. With a CBDC, the government knows where, when, and how you spend your money. This level of control raises concerns about freedom, especially if limits are placed on certain spending habits. For example, what if policies restricted you from buying too much fuel, alcohol, or even traveling too frequently for environmental reasons? The infrastructure could easily be programmed to block or decline those payments instantly. The impact on everyday life could be massive. For older generations who rely on notes and coins, the shift would be alienating. For small businesses, especially those in rural areas, losing the ability to deal in cash could threaten their survival. Most importantly, ordinary people could find themselves at the mercy of policies they never voted for. While the government frames the digital pound as progress, the hidden reality is that it could hand over unprecedented control of your financial freedom. The question we should all be asking is this: if money goes fully digital and fully monitored, do we truly own it anymore, or are we just being allowed to use it under someone else's rules? Number 2. The Cashless Society Push. Across the UK, the move toward a cashless society is accelerating faster than most people realize. More shops, cafes, and even public transport systems are adhering to refuse cash payments, accepting only cards or digital wallets. On the surface, this looks like convenience. No loose change, no worries about counterfeit notes, and faster checkouts. But beneath the shiny surface lies a potential nightmare for millions. If cash disappears completely, those without access to reliable banking or digital tools, such as the elderly, vulnerable, or people in rural communities, could be left behind. Imagine being told your perfectly valid £10 note is no longer good enough to buy a simple loaf of bread. Governments argue that going cashless helps tackle money laundering, tax evasion, and criminal activity. However, critics warn that the real impact will fall on ordinary citizens. With every transaction forced through digital systems, banks and financial institutions gain full visibility over your spending. That means less privacy, more fees, and even the potential for accounts to be flagged or frozen over technicalities. In a world where every purchase is traceable, people lose the ability to make private choices about their own finances. The very freedom that physical cash provides, the ability to spend without surveillance, would vanish overnight. This isn't just about convenience, it's about control. For small businesses, especially family-run shops or market stalls, the costs of installing and maintaining card machines can be crushing. If forced into digital-only transactions, many could face closure. And for individuals already struggling with debt or lacking access to traditional banking, the shift could mean exclusion from daily life. Consider the scenario where an internet outage prevents card machines from working. In a cashless society, that means no food, no travel, no essentials. Life grinds to a halt. What looks like progress could easily become vulnerability. The truth is, cash isn't just money, it's independence. Once it's gone forever, and rebuilding that freedom may prove impossible. The question is, Are we really ready to trade privacy and security for the illusion of digital convenience? Number 3. Energy price regulations and green taxes. One of the biggest changes hitting households across the UK comes from energy price regulations and new green taxes linked to climate policies. On paper, these laws are meant to push the country toward net zero, encouraging people to use cleaner energy and reduce reliance on fossil fuels. But for the average family, the result is painfully clear. Higher bills, heating your home, charging your car, or simply turning on the lights could become far more expensive. When combined with the cost of living crisis, even a small rise in energy tariffs has the potential to push millions into financial strain. What's framed as an environmental win may feel like a financial trap for everyday households. The government insists that these levies and price caps are designed to protect consumers in the long run. They claim that investment in renewables will eventually lower prices and create a more sustainable energy market. Yet, in practice, households see immediate costs while the promised benefits remain decades away. For example, the push toward electric vehicles brings new hidden costs, charging infrastructure, increased electricity demand, and taxes on petrol to encourage the switch. Even landlords are being pressured to upgrade rental properties with expensive green renovations, costs that are often passed straight on to tenants. What's sold as a climate solution often becomes another line item on the public's monthly expenses. For working-class families already budgeting down to the penny, this shift could mean choosing between heating and eating during winter months. For small businesses, rising energy bills cut into profits and threaten jobs. And for rural communities that rely heavily on cars and oil heating, the burden could be devastating. There's no doubt that protecting the planet matters, but the way these green taxes are structured risks deepening inequality. Wealthier households may absorb the costs, but ordinary people will feel the pressure immediately. The deeper question is whether the push for net zero is being balanced fairly, or whether it's quietly becoming another mechanism that drains the pockets of the public, while offering little short-term relief. Number 4. Tax on savings and investments. For decades, UK savers relied on tax-free allowances to grow their money without losing too much to the government. But new rules targeting savings and investments are starting to erode that security. Changes to ISA limits, reductions in dividend allowances, and stricter rules on capital gains tax mean that ordinary people are paying more tax on money they've already earned. What once felt like a safe way to prepare for the future, tucking away cash in a savings account, buying a few shares, or investing in property, is now being quietly penalized. The harsh reality is that your hard-earned nest egg is no longer just yours, it's becoming another revenue stream for the Treasury. These laws are often framed as targeting the wealthy, but in practice, they hit the middle class hardest. Families who carefully set aside money for emergencies or for their children's future find that returns are eaten away by taxes. Even modest dividend income, which many retirees rely on, can now trigger unexpected bills. The reduced capital gains threshold means that selling assets like shares or a second property may cost significantly more than before. Instead of encouraging people to be financially responsible, the system now feels like it punishes saving. For many, it raises the uncomfortable question, is it even worth investing if the government takes such a large slice of the reward? The impact extends beyond individual households. A decline in savings and investment activity weakens the overall economy, limiting the flow of money into businesses that depend on investors for growth. Meanwhile, people who keep money in traditional savings accounts see returns swallowed by both inflation and increased taxation. Those trying to achieve financial independence feel trapped, stuck in a cycle where saving doesn't pay and spending feels riskier than ever. The message these laws send is clear. The government prefers short-term revenue over long-term prosperity. For individuals, the lesson is even sharper. If you're not strategic about where and how you save, new tax rules could drain away the very future you've been working to build. Number 5. Pension reform. One of the most personal financial changes facing the UK is the wave of pension reforms currently underway. For many, the state pension represents the foundation of their retirement plan, something they've contributed to for decades through national insurance. But the rules are shifting. The pension age is steadily rising, meaning people will have to work longer before they can claim what they've already paid in. For someone in their 40s today, This could mean working until 68 or even older before qualifying. The uncomfortable truth is that the promise of a secure retirement is being pushed further out of reach, leaving many to wonder whether their golden years will truly be golden at all. It isn't just the age of retirement that's changing. The way private pensions and workplace schemes are taxed and regulated is also being adjusted. Annual contribution limits and lifetime allowance thresholds are becoming tighter, affecting not just high earners, but ordinary workers trying to save consistently. For many employees, especially those in middle income brackets, this means paying higher taxes on their pension pots or losing out on employer contributions. Even small changes in these rules can cost individuals thousands of pounds over the course of their working life. And for younger generations, the uncertainty about whether pensions will hold their value creates an added layer of financial anxiety. The wider impact is significant. With people expected to work longer, career planning becomes more stressful, particularly in physically demanding jobs where staying employed into the late 60s is unrealistic. Retirees may also find their income squeezed by inflation and shifting tax rules, undermining decades of careful planning. This could force more people to rely on personal savings, property, or even their children to cover living costs in old age. What's presented as reform often feels more like reduction, taking away benefits instead of strengthening them. The shift in pension policy raises a fundamental question. After years of contributing faithfully, will citizens actually receive enough to live on, or will retirement become another financial struggle rather than a well-earned rest? Number 6. Property and rent laws. The UK housing market is being reshaped by a wave of new property and rent laws, and the effects reach far beyond landlords. Recent legislation has tightened rules around buy-to-let properties, increased property taxes, and introduced stricter requirements for energy efficiency in rental homes. On paper, these changes are designed to improve housing standards and protect tenants, but in reality, the cost is often passed down the chain. Landlords faced with higher mortgages, compliance costs, and taxes frequently respond by raising rent. For tenants, this means soaring monthly bills at a time when wages are already stretched. For prospective buyers, stricter lending rules and higher stamp duty make stepping onto the property ladder even harder. Critics argue these laws are creating a perfect storm. Landlords selling up due to new regulations reduce the overall supply of rental homes, while demand continues to grow. The result is a sharp rise in rental prices and fewer options for those who cannot afford to buy. Families are forced into smaller spaces, longer commutes, or unstable short-term agreements. Meanwhile, first-time buyers find themselves competing in an overheated market where prices climb faster than savings can grow. Even homeowners aren't immune. With changes to council tax and property-related levies, keeping a home becomes increasingly expensive. What's presented as fairness often translates into financial pressure for nearly everyone involved. The wider consequences are deeply concerning. Rising rents push more people into housing insecurity, while younger generations delay milestones like starting families or buying homes altogether. The dream of stable homeownership, a cornerstone of financial security for decades, is fading. Small landlords, once a vital part of the rental market, are squeezed out, leaving larger corporations to dominate. This shift threatens community stability and reduces the diversity of housing options. In the end, both landlords and tenants lose. One side struggles under heavy regulation, and the other suffers from spiraling costs. These property and rent laws highlight how quickly housing can turn from an asset into a burden, leaving millions of people questioning whether a secure home is still achievable under the current system. Number 7. Inheritance tax and wealth transfer. Few financial topics stir as much emotion as inheritance tax, because it touches families at their most vulnerable moments. In the UK, the threshold for tax-free inheritance has remained stubbornly low, even as property values have skyrocketed. This means more ordinary families, not just the wealthy, are finding themselves hit with large tax bills when passing down a home or savings to the next generation. What was meant to be a gift of security for children or grandchildren often turns into a financial headache. The very idea that your family could lose a significant portion of the assets you've worked a lifetime to build feels deeply unfair, yet current laws make it a reality for many. Supporters of inheritance tax argue that it reduces inequality by redistributing wealth, but critics say it unfairly punishes people who have already paid taxes throughout their lives. If you buy a house, you pay stamp duty. If you save money, you pay income tax. And when you invest, you face capital gains tax. Then when you pass away, a large portion of your estate can be taxed yet again, often at 40%. Families may be forced to sell cherished homes or liquidate assets simply to meet the government's bill. This creates an added layer of stress during a time of grief and undermines the concept of financial planning across generations. The broader consequences ripple through society. Rising house prices mean that even modest properties in certain regions now exceed inheritance thresholds, pulling more middle-class families into the tax net. This discourages people from saving or investing in property, knowing much of it may not stay within the family. It also widens the gap between those who can afford complex tax planning and those who cannot. Instead of encouraging stability, the system fuels resentment and uncertainty. Ultimately, inheritance tax doesn't just affect the wealthy, it affects anyone hoping to leave something meaningful behind. The bigger question is whether future generations will ever enjoy the same opportunities, or if wealth transfer in the UK is quietly becoming a privilege only for the few. Number 8. Road and vehicle laws. The UK's recent push to reduce emissions and promote green technologies has led to a dramatic shift in road and vehicle laws. These new regulations are designed to reduce air pollution and encourage the adoption of electric vehicles, EVs. But they come at a cost for the average driver. Ultra-low emission zones, ULEAs, are expanding, and congestion charges are being introduced in more areas, targeting older cars that don't meet strict environmental standards. For people who rely on their vehicles to get to work, run errands, or care for family members, these charges can quickly add up. What was once a modest fuel cost is becoming a serious financial burden, especially for those living in urban areas. The transition to electric vehicles is being heavily incentivized, but the upfront costs of purchasing an EV can be prohibitive. For many families, it's simply not financially feasible to make the switch, despite the promises of government grants and incentives. And it's not just the cars themselves. The new regulations require significant changes to charging infrastructure and vehicle maintenance, which can add unexpected costs. For those living in older properties or in rented accommodation, the lack of accessible charging points further complicates the shift to electric. Drivers may find themselves paying hefty charges just to get into the city, while struggling to afford the transition to greener alternatives. The broader impact of these laws is creating a divide between urban drivers and rural residents. Those in cities with easy access to public transport, EV infrastructure, and clean energy benefit from the new laws. But for people in more rural areas, where public transport is limited or non-existent, the shift to electric and the increasing costs of driving can feel like an unfair burden. Older vehicles that don't meet emission standards are essentially being phased out, forcing people to choose between upgrading to expensive new technology or paying hefty fines. These new laws are transforming the roads from a place of convenience to a battleground of financial hardship for many, leaving drivers wondering, is it worth it to keep your car in a world where driving is becoming an ever more costly privilege? Number 9. Online safety and financial tracking. The UK is stepping up its efforts to combat online fraud and protect personal data, but this new online safety legislation comes with unintended consequences, especially when it comes to financial transactions. As more of our lives move online, banking, shopping, investing, the government is introducing stricter rules to monitor and control cybersecurity. While this sounds positive in theory, it opens the door for heavy surveillance and tracking of personal financial activity. Under new laws, your online behavior could be scrutinized more than ever before, from your bank transfers to online purchases, making it easier for both hackers and authorities to see where your money is going. One of the most concerning aspects of these changes is the impact they could have on privacy. As the government collects more data on your digital transactions, there's a growing risk that this information could be misused. Financial institutions already track your spending habits to offer tailored ads or services, but new rules could see that data passed on to authorities for various purposes, potentially including investigations into your spending. Whether it's your credit card usage or investments in cryptocurrencies, these laws could force individuals to disclose more than they want, undermining financial autonomy. The question becomes, how much privacy are we willing to sacrifice in exchange for safety from fraud? Furthermore, these laws could dramatically affect how people use alternative investments like cryptocurrencies or peer-to-peer lending. In an effort to combat money laundering, stricter KYC, Know Your Customer, and AML, anti-money laundering rules are being applied to all online financial activities. This means more documentation, more red tape, and possibly even restrictions on what you can buy or invest in online. While the intention is to protect against financial crime, it could stifle innovation and financial freedom. Imagine trying to invest in startups, buy art, or make international transfers, all under a microscope of government control. These shifts are forcing us to choose between protecting our privacy and enjoying the ease of modern finance. Number 10. Emergency banking powers. Perhaps the most alarming of all the new financial laws is the increasing scope of emergency banking powers. The UK government is gradually gaining the ability to freeze accounts and control banking activity during times of crisis, whether it's for national security, fraud investigations, or economic emergencies. What this means is that, under certain conditions, your bank account could be locked without notice or warning. Imagine being unable to access your savings, pay bills, or withdraw cash, simply because the government has flagged your account for one reason or another. It sounds like a nightmare scenario, but it's becoming a reality for more and more people. While these powers are presented as necessary for protecting the financial system during extreme events, they raise serious concerns about civil liberties and financial freedom. It's easy to see how a system designed to target criminals or terrorist financing could be misused or over-applied to ordinary citizens. Without sufficient checks and balances, people could find their accounts frozen without explanation, and it might take weeks or months to resolve the issue. This creates an environment where the public's ability to manage their own finances is directly controlled by the state. The question becomes, how much power should the government have over our personal wealth? The long-term consequences of these emergency banking laws are profound. Ordinary individuals could lose the ability to freely use their money during times of financial crisis. For example, if you're caught up in a scam, a fraud investigation, or even an economic downturn, you might suddenly find yourself unable to pay for essential goods, healthcare, or support your family. It's not hard to imagine how a temporary freeze on your account could escalate into a full-scale economic lockdown for individuals. The fundamental right to own and access your money is at risk, and these sweeping powers could ultimately undermine the financial security many of us take for granted. What's at stake here isn't just access to funds, it's the control we have over our financial autonomy. As we've seen throughout this video, the UK's new laws are reshaping the way we handle money, savings, and even the freedom to spend. From the digital pound that could track every purchase to emergency banking powers that could freeze your account at a moment's notice, it's clear that financial freedom is at risk. What's even more concerning is how these laws impact ordinary people the most. Those who are just trying to save for the future, maintain a home, or ensure their family's well-being. Every new regulation seems to carry hidden costs, whether in the form of higher taxes, less privacy, or increased financial pressure. It's up to us to stay informed, ask the tough questions, and understand how these changes could affect our everyday lives. While some of these laws may be well-intentioned, the reality is that they have the potential to strip away the financial independence we've worked so hard to build. If we're not careful, the very tools we use to manage our money could become mechanisms of control. So what do you think about these changes? Do you feel ready to face them, or do you think it's time to start pushing back? Drop a comment below and let's hear your thoughts. Your opinion matters. Also, don't forget to check out our previous video where we dive deeper into financial freedom tips that could help you navigate these new challenges. We put tons of effort into bringing this content to you, so please support us by hitting that subscribe button. It's just one click, but it means the world to us. Thank you for being part of our community.